Hello and welcome to StudyIQ. In this session, we will discuss about the factors that is leading to the stressing of Indian rupee. So let us see what has caused this stress on the Indian rupee. The reason for this stress is depreciation of currency. What is meant by depreciation of currency? Depreciation of currency means that the currency has lesser demand in the market and this has led to lesser value of that currency. So the reason is demand of Indian rupee has come down and this has led to decrease in the value of Indian rupee. So this phenomena is known as depreciation. So in the current context, let us see what are the reasons for the depreciation of currency or Indian rupee. So in the current scenario, there are mainly two reasons accounting for depreciation of Indian currency. The one is rising oil prices and the second one is increasing FII outflows. FII outflows. Let us see the reasons one by one. Coming to the FII outflows. What is meant by FII? It is foreign institutional investment. FII is a kind of foreign investment where the investor would share in the debentures or equity of Indian share market. So here in under FII, the investment is made either in the equity, that is the shares of a company, or as debentures of a company. So this is not an investment in the infrastructure of the company, which means that the FII investors can withdraw their money anytime. That is why we say that there is high level of volatility associated with foreign institutional investments. So it means the FII investors can withdraw their money from our country any point of time. Now let us see what is the reason that has caused outflow of FII from Indian market. There should be some reason. So now we said that there is a large number of FII withdrawals now. So let us analyze what are the causes for this FII withdrawals from our country. The first reason is increasing demand for US dollars. When the demand of the US dollar increases, what will happen? This will lead to an increase in the value of US dollars and there will be a shortage of supply as well. When demand increases or when the aggregate demand is more than the aggregate supply, there will be a shortage. So there is a shortage problem associated with the US dollar. So there is a shortage of this particular currency and this shortage has led to an increase in the value of US dollars. What is the reason for increase in demand of US dollars? Let us see. So the reason is that the US Federal Reserve, that is a central bank of the US economy, that is US Federal Reserve, has announced its policy rates. The interest rates have been announced and the interest rates are high, and it has also promised that in the future they will be increasing the interest rates. That means in the US economy the market interest rates are high. So the reason for this is increase in the market interest rates. As a result of this increased market rates or market interest rates, the demand of the dollar will increase and the supply will come down. So there will be a demand supply gap and therefore the value of the dollar will appreciate or increase. Another reason is that there is a 3% yield rise for the US Treasury bonds. This means that the US Treasury bonds will now give more returns for the investor. Here you must understand the term yield. What is a bond yield? You should also know what is a bond, what is bond yield and what is a bond return as well. So in this session itself, later we will discuss about bonds and bond yield as well. So now here you must understand that when the bond yield increases, this will promise higher returns to the investors. This concept will be clear when we learn about bond and bond yield. I will cover the topic in this session itself. So an increase in the market interest rates as well as the bond yield in the US market will attract the investors to US economy. So there will be more outflow of FIIs from our economy. Coming to the rising oil prices. So this is another reason which has depreciated the rupee. Let us see what are the reasons for rising oil prices in the economy. The first reason is restrictions by the Opec. OPEC means Organization of Petroleum Exporting Countries. It is an intergovernmental organization. And what is the purpose of this organization? It coordinates and unifies the petroleum policies of its member countries. So, who are the member countries of OPEC? The member countries are oil exporting countries. So, this intergovernmental organization unifies and coordinates the policies of its member countries. So, they make decisions. And now, what is the decision made by the OPEC? It has decided that it will follow tight output controls. So, tight output controls means it will curtail the supply or restrict the supply. So, when supply of oil comes down, what will happen? The demand is still the same. So, demand is more than the supply. What will happen? The prices will rise. One reason is tight output controls by the OPEC. The second reason is that Saudi Arabia is the world's largest oil producing country. So, this country has increased the prices of oil in order to meet the budgetary demands of that country. So, this is another reason which has led to an increase in the oil prices. Another reason for increase in the oil prices is that the tensions between the Iran and US over the nuclear deal pullout. So, nuclear deal related tensions. So, US is actually planning to withdraw from the nuclear deal, and this has caused another tension, and this is one reason for increase in the oil prices. The nuclear deal pullout itself is an important topic which we will cover later in some other module. So, these are the three major reasons which has accounted for increasing oil prices in the world market. Here you must also understand that there is a possibility of US shale oil production or output, but you must make the point clear that even that will not be enough to bring down the price rise, because the supply is shortened or cut short, but the demand is still the same. The demand is very high. So, even though the US comes up with the US shale oil, still it will not be sufficient to bring down the price rise. So, we have seen what has caused the depreciation of rupee, that is decrease in the demand of rupee, and which has led to a further reduction in the value of rupee. Mainly there are two reasons. One is rising oil prices and the other one FII outflows. So, the depreciation of rupee must have some impact on the Indian rupee. So, let us see what are the impact of this depreciation on the Indian rupee. As we all know, India is extremely dependent on crude oil imports for oil demand in the country. So, we cannot forego import of oil from other countries. So, when the price of the oil increases, what will happen? It will lead to increased crude import bill. So, we said India depends on imports for crude oil requirements, and this will increase the crude import bill, which means that the imports of the country will increase. So, when the country's imports increases, what will happen? Imports become greater than the export. So, when imports becomes greater than the export, we call this as current account deficit. This is known as current account deficit. And when the prices of the oil increases, the import bill also increases, which means that the imports also increases, or the payment for the imports also increases. So, what will happen? This will widen the current account deficit. This current account deficit will widen, or this will increase. This increasing current account deficit or the trade deficit, we call this trade deficit. Why? Because these are visible items. So, we call it trade deficit also. So, when the trade deficit increases, what will happen? This will badly affect the BOP situation of the country. BOP is balance of payment. So, balance of payment situation of the country will be worsened, which means we will have lesser forex reserves. Our forex is flowing out of the country as import bills. So, the forex in the country will come down. This will weaken the rupee. Again, this will add on to decrease in the value of rupee and further depreciation of the currency. Again, The second one, coming to the FII pullouts. So FII pullout means that FII is flowing from the country. So there is an outflow, which means that there is an increased rupee supply in the international currency market. So FII is flowing out of the country, which means increased supply of rupee in the international currency market. And when supply of Indian rupee in the international market is more than what is the demand for Indian rupee, what will happen? When supply is more than the demand, we have already seen that in case of commodities, the price will come down. When supply is more than demand, the prices of the commodities will come down. And when it comes to rupee or a currency, what will happen? The value, it is similar to price, the value will come down. So when supply more than demand, the value will come down. So the value of Indian currency will come down. And this phenomena, the decrease in the value of currency is called depreciation. This will add on to further depreciation of the currency or rupee. So again when there is depreciation of the currency, what will happen? We will have to pay more in terms of imports. We have already seen that how it happens. So let us see an example again. Suppose the value of the currency against $1 is rupees 60. So after depreciation, the value of rupee comes down. So now in case of $1, you have to pay rupees 65. So what will happen in case of imports? You have to pay more rupees for importing commodities. Let us see how. Suppose earlier we were buying commodities for $100. So 100 into 60 will give you 6,000. And now it is 65. 65 into 100 is 6,500. So when you import commodities, it means that you are paying them. So earlier it was 6,000 rupees that you had to pay, but now it is 6,500, which means with depreciation of currency, your import bill also increases, or you have to pay more for your imports. So again that will add on to the BOP crisis in the country. Now let us see what is a bond. Bond is a financial instrument. It is a debt instrument. You should know that it is a debt instrument. The maturity of bond is more than 1 year. And you should understand that the interest of the bond will be mentioned in the bond itself. And two terms you should know. One is issuer of the bond and the second one is who purchases. So anybody can purchase the bond, general public, banks, financial institutions, etc. And who issues bonds? Bonds can be issued by the government or by any companies or by banks, etc. In case of government bonds, which will be in the form of government securities or GSECs, they are risk-free and people will be willing to purchase the government bonds because they are risk-free. We will see a very important term related to bond, that is the bond yield. Suppose the value of the bond is 10,000 rupees. Suppose you are purchasing the bond for how much rupee? 10,000. So 10,000 rupees, and this is known as the face value of the bond. Face value of bond. And we have said that the interest of the bond will be included in the bond itself. So it will be mentioned in the bond itself. Let us assume that the interest is 10%. And let us assume the maturity is 10 years. So the face value is 10,000 rupees, interest is 10% and maturity period is 10 years. So what will be the bond yield? So this is 10%. So 10,000 into 10%, 10 divided by 100. This is 1,000. So the bond yield will be 1,000. This is the bond yield. The rate of interest. This is the bond yield. You should understand this term. Suppose A has purchased this bond for 10,000 rupees at 10% interest. The maturity period 10 years and the bond yield is 1,000 rupees. Now A feels that he should sell it. So he is in need of some money. So he feels that he should sell his bond. So what he will do? He can take it to the secondary market to sell this bond. And in the secondary market, you should understand that the bond price may be higher or lower. Here the face value is 10,000. So based on demand and supply of the bond, in the secondary market, the prices may vary. It can be either high or it can be low also. So A can either get more than 10,000 or A can even get less than 10,000. So in this case, let us assume that A is selling the bond for less than 10,000. So he is thinking already 1 year has gone. So he has already got bond yield 1000 rupees and he sells this for 9,000. So he is in urgent need of some money. So he sells this for 9,000 rupees. And this 9,000 rupees is known as real bond value. So when you sell this bond in the secondary market, the price you get from selling the bond is known as the real bond value. Okay, so A has sold this bond to B. So after again 1 more year, that is from the issuance, already 1 year has been gone with A. After selling it to B, again 1 year has gone, and after that 1 year, what will B earn? Let us see. So B will earn on the face value, not on the purchasing amount or real bond value. So here for B also, the rate of interest is calculated on the basis of the face value of the bond, not regarding the real bond value or the amount at which B purchased. So 10,000 into 10 by 100. He will also earn 1000 rupees. Why he is earning 1000 rupees? Because the interest is calculated on the face value, not on the real bond value. Real bond value is the amount at which B has purchased the bond from the secondary market. So here he has earned 1000 rupees and this means that his return is more than 10%. His return is 11.1%. Why? Because he has earned this 1000 rupees from 9,000. He has only given 9,000 rupees. He purchased it for 9,000 rupees. So from that he is earning this 1000. So his yield is more or his return is more. So what do we understand from this? We understand that bond price has fallen. What is the bond price? Real bond value. This is the bond price. So when real bond value has come down, it has fallen. See here earlier the face value was 10,000 and real bond value is 9,000, which means that face value is more than the real bond value. So when real bond value or the bond price decreases, what happens? The yield increases. So there is an inverse relationship between real bond value and the bond yield. Real bond value also known as the bond price. So when bond price decreases, bond yield increases. So we understand that bond price and bond yield are inversely connected. When bond price decreases, bond yield increases, and when bond yield increases, bond price, and when bond price increases, bond yield decreases. So here in this example, this is for our understanding that we have taken the face value as 10,000, the rate of interest as 10%, etc. But when it comes to reality in the stock markets, these transactions will be in terms of crores of rupees. Now let us see what are the factors that will influence the bond yield in a market. First of all, the market interest rates. That means the interest offered by the banks. So what will happen? When the interest rates in the market increase or when the banks increase their interest rates, demand for bonds will come down because in the banks they are offering more interest rates, which means higher returns are offered. So what will happen? As a result, the demand for the bonds will come down. And when the demand for the bonds comes down, the bond holder will sell the bonds at lower rates in the secondary market. We have seen the previous example. The face value was 10,000 but sold in the secondary market for 9,000 rupees because there is lesser demand for bonds. So when the demand is less or when demand decreases, the price also comes down. So when market interest rates goes up, there will be lesser demand for bonds. So lesser demand for bonds means that lesser price for the bonds. Here you must understand that money has higher demands when the interest rates are high in the economy. So this is the same thing what has happened in the US economy also. In the US economy, we have seen that US Federal Reserve has increased the interest rates in the economy and it has also pledged for further increases. And as the market rate comes down, what will happen? As the market rate comes down, bonds become more attractive because bond will give more returns for the investors. Therefore, the bond value also goes up. Another thing is the risk associated. So, comparatively, bonds are safer investment options. So, as the economic uncertainty in an economy goes up, the demand for bonds also increases because there is economic uncertainty in the economy. So, people will prefer for less risky bonds.